What's up, guys, and welcome back to the Blockware Intelligence YouTube channel. My name is Blake Davis, and I'm back for episode 3 of Crypto Equity Investing 101. This episode is a follow-up to the previous episode, and that episode built off episode 1. We've gotten a bit more technical with every episode, so if this is your first time here, I'd highly recommend going back to episode 1. At the end of this video, I'm going to walk you guys through a real-world example of how I'd go about finding a buy signal for a stock using all of the things we've discussed so far, so be sure to stick around. As a reminder, none of the information in this series is investment advice. I'm not a certified financial advisor, and nobody should pursue any investment strategy without first conducting proper due diligence. So a short recap of episode 2 to jog your memory is that we discussed a few things. First, I introduced the concept of price action. We as investors like to use candlestick charts because they give us 4 data points instead of 1 on a line chart in a pretty easy to understand format. I use the analogy that a candlestick is a game of tug of war between buyers and sellers. So if we turn that candlestick 90 degrees counterclockwise, so your buyers are on the left and sellers are on the right, we can imagine that the price action of that day is a game of tug of war where sellers want to drag that closing price to the right and buyers want it to the left. By examining the body and wicks of the candle, we can determine which party was in control for most of the day and who ended up winning, which we, as we discussed, can tell us a lot about a stock. I also discussed the metric of volume. Volume is the number of shares traded that day and works to put an emphasis on price moves. I explained that we need institutional accumulation, so that's hedge funds, mutual funds, etc. And they're the real drivers of the market because they're deploying millions or billions of dollars into stocks, which is what can truly drive a name on a multi-month move. Remember in episode 1, we discussed that price is king and volume is number 2 behind price. We don't necessarily need volume because you only make money when price moves, but we can be a lot more confident when there's strong volume. So now let's get into some new stuff. First, I'm going to discuss one of the most important cornerstones of trading, and that is support and resistance. I like to think about these as the floor and ceiling of our stocks. So if you think about price action like a bouncy ball that you throw as hard as you can against the ground, so hard that it hits the ceiling, the ground would be support and the ceiling would be resistance. Let's ignore the laws of physics and pretend that ball would bounce up and down until either the floor breaks or the ceiling. That's what a stock does when it's trading between support and resistance. So support is a floor where every time a stock gets around a certain price, buyers tend to step in and drive prices back higher. This happens for a few reasons. One is that a price can be a psychological level that makes investors believe they're getting in that stock for a deal. Another reason is that many people trade using support and resistance so that it almost becomes a self-fulfilling prophecy. So that name support comes from the idea that the price is falling until buyers come in to give that stock some support to head back higher. And resistance is the exact opposite of support. It happens when a stock is increasing in price until there's a zone where sellers step back in and steal control from the buyers. The reasons as to why resistance exists is the same as it is for support. Sellers think that this is a good place to take some profits or go short because that stock has been unable to cross that threshold in the past. So let's look at a real-world example of support and resistance. As I mentioned, support and resistance are extremely useful and a massive part of analyzing price action. So you'll find examples all over the place. So this is Microsoft, which created this really clean range in the third quarter of 2019. So I've highlighted in red here this resistance zone and in green this support zone. So as you can see, Microsoft traded sideways in this range for about 3 or 4 months before breaking out to the upside for a roughly 36% gain. So it can be a little confusing at first about where exactly to draw support and resistance lines, and it isn't really an exact science, but essentially we're connecting the tops and the bottoms of these candlesticks to identify the floor and ceiling of a trading range. So what happens when a stock trades sideways is that demand is building up for that name. So if you remember in episode 1, I discussed how stocks trade higher or lower due to the basic laws of supply and demand, and when buyers and sellers are in a heated battle, volatility will dry up, causing that stock to go sideways. This wears out both buyers and sellers, and ideally, we'll see volume dry up as people aren't actively trading it as much and eventually give up for now. This creates this dry powder for these people to be able to enter later on the breakout. I like to think of sideways, choppy price action like that stock is a can of soda. So the can is being shook around as the stock moves sideways and chops, which builds up all this pressure inside the can. And once that can is open, or the stock is finally able to clear up through this resistance, it will hopefully explode to the upside, ideally on large volume. And the same thing goes if it breaks down below support. So Microsoft created a pretty clear buy signal on this day here as it gapped up through resistance. This is a very powerful signal of strength, as demand was so high in pre-market that it was able to clear through resistance, and as you can see, it basically never looked back. A lot of newer investors are scared of gap ups, but if you're able to manage risk correctly, then there's nothing really to be scared of. But we're going to get into risk management in later videos. So now that we know the basics of support and resistance, we can talk more about trend lines. And the trend line is just the line on the chart that we draw to visualize support and resistance, but they don't have to be perfectly horizontal. So here's another example of a trend line breakout using Tesla from September to November of 2020. As you can see here, Tesla wasn't trading sideways, but instead it was sloped down. But we can still draw a resistance line across the tops of the candles and use it to trade. This slanted trend line was the same thing as resistance, but instead of Tesla hitting one price before selling off again, it was riding down this trend line. This is a good example of what I just explained with volatility contraction when we're range bound. Tesla made this triangle shape, which is what I call a wedge, where the highs got lower. As you can see here, this next high is lower, and this last high is lower, and the lows get higher, as you can see here. And this occurs over and over again until demand is finally able to outpower supply, and Tesla went on this 100-ish% run in only a few months. So now let's talk a little bit about what's probably the most used indicator out there behind volume, and that is the moving average. So a moving average is exactly as the name suggests. It's the average price that the stock has transacted at over, X amount of days, weeks, minutes, whatever you want. And this average price is moving. So as that stock's price moves throughout the day, the moving average is adjusting to that. This average price is plotted out as a line on the chart that I'll show you guys in a second. So there are two main types of moving averages. We have the simple moving average and the exponential moving average. The difference between these is how the values are calculated. And it's a little bit complicated, but all you have to know is that the simple moving average is a basic moving average. So all periods, which is, a day, a week, whatever, are equally weighted. So if it's a 50-day SMA, simple moving average, the price from 50 days ago has the same weight on the average as the price today does. Now, the exponential moving average is weighted more towards the front, so recent prices will affect the average value more than distant ones. There are use cases for both of these types of moving averages, but essentially it comes down to personal preference. So why do we use moving averages? Well, there's two main uses. The first is to provide buy and sell points. So oftentimes moving averages become areas of support or resistance. So if price is above a moving average and falls down to that average value that's used by a bunch of different people, then people will buy there and the stock will tend to bounce off that moving average. A way to kind of make sense of this is pretend you're a fund manager. You're managing money for your clients, and you're able to say, hey, look, I bought you guys this stock at the average price from the last 50 days or 200 days or whatever. So you're able to tell your clients, like, look, you didn't overpay for these shares. And the same goes for when a stock is below a moving average and then rises up to meet it. This is an area where people will often sell a stock because the price, if it's below the moving average, has likely been in a downtrend for some time now. And now these fund managers are able to say, hey, look, you got out at an average price and not below average. Another basic use for moving averages is to indicate the trend of that stock. So trading with the trend is super important because it gives us the greatest odds of success. We talked about this a little bit in episode 1 about how as traders and investors, we're always looking for an edge. And that's a scenario where the likelihood of one thing happening is greater than another. So trading with the trend gives you a massive edge and gives us the greatest odds of success. So, you wouldn't jump onto a sinking ship. So why would you buy a stock in a downtrend? You might think you're getting in for cheap, but if the stock's in a downtrend, chances are institutions are clearly unloading their positions. So the chance that you're going to pick the bottom are essentially zero. So one way I use moving averages to judge the trend is looking at the slope of the moving average. So if the moving average is pointed down, that means over the last X amount of periods, the average price is declining, which would indicate a downtrend. Furthermore, we can compare two moving averages to each other. So the two moving averages you're comparing to one another are dependent on if you want to know a short-term trend or a long-term trend. So for example, a common shorter-term trend indicator would be to compare the 10-day and 21-day moving average. So if the average price for the last 10 days is below that of the last 21 days, then that stock would be in a short-term downtrend. This is because moving averages using the least amount of periods are what we call faster moving averages. So those ones adjust more quickly to today's price changes because one day has a bigger weight on the average. So for example, a 10-day moving average, one day is 10% of that average price versus a slow moving average like a 200-day moving average where one day's price action is like 0.5% of that average value. So here I've also included the main moving averages that I personally use. I definitely use a few more, but these are kind of my bread and butter and what I'd recommend you start out with using. The 50 SMA is the simple moving average, is the most important moving average out there because it's the most widely used. Hedge fund manager Jim Ropel calls this your guardrail. So a good general rule is to never buy anything below its 50 SMA and sell if it breaks it on large volume. So now let's combine everything we've used today in one more real-world example. This is Apple from May 2021, which went on this 26% run in about 3 months. So since price is king, the first thing I'm looking at are the candlesticks and these trend lines that I've drawn on there for you. You can see that this slanted resistance line was what defined the range that Apple was trading against. We would have been waiting for Apple to break up through that trend line and buyers to regain some more footing before we're really interested in buying. We can also see this horizontal trend line that I've put in there, which would have signaled the buy point for me on this day. You can see that Apple was building out this rounded shape, which is what we'd call a cup. So I'm never looking to buy the bottom of a base in here, but instead I'm looking for a buy point once we start building out the right side of this base. So now let's put on some moving averages. So as you can see here, Apple had traded down to its black simple moving average and held it 3 times, right? Here, here, and here. So clearly investors were looking to accumulate shares at that 200-day average price, which was the first bullish signal for Apple at the time. We can also overlay the 21 EMA here, which was a resistance point for Apple on the way down. So you can see it ran into it here, it ran into it a bit here, and then finally it was able to break above it in here, which would have been the second green light for Apple. And then finally on this day, Apple was able to clear above that horizontal resistance line, and then also this red 50 simple moving average, Apple was able to break above it. So as I mentioned, the 50 SMA is your guardrail, and we never want to buy stocks below the 50 SMA. So the fact that it broke both resistance and the 50 SMA would have been a bullish signal for me and where I would have been buying this stock. So now I've overlaid all of these moving averages, including a green 10 EMA here. So you can see here on this day, 2 days after that buy signal, the 10 EMA crossed over the 21 EMA, which would have been the signal that Apple was in a confirmed shorter-term uptrend. So yeah, that's all I've got for you guys. We got a little bit more technical here, so I hope it wasn't confusing. If you have any questions or feedback, feel free to leave a comment below, or you can message me on Twitter. My account will be in the description. If you've been enjoying this series, you can go ahead and leave a like below, subscribe to our channel, and look out for future videos. Thanks.